Welcome to ETF Explained, a series on the Get Started Investing podcast. Each episode we explain one ETF to better understand it and to help you build the skills to analyze any ETF. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Today, we are talking about the JPMorgan US 100Q Equity Premium Income Active ETF Managed Fund. The ASX ticker is JPEQ or JPEQ, and we're not doing it alone. We actually have the portfolio manager for this fund, portfolio manager for a number of JPMorgan funds, including the world's largest active ETF. He's also the CIO of US core strategies at JPMorgan Asset Management. Hamilton Reiner, thanks for joining us.
Thanks for having me, guys. Really appreciate it.
So in today's episode, as you said, Ren, we're doing JPEQ. And let's start with the name, because it was a big one. JPMorgan US 100Q Equity Premium Income Active ETF Managed Fund.
There's no word limit on the the names, are there?
You don't have to pay per word.
Yeah. So as always, when we're analyzing an ETF, the name is sort of the window into it gives us a lot of information. So the product issuer, JPMorgan Asset Management, the assets that you're investing in, Hamilton, are equities. Focus of the fund, income, which is something we'll talk about in a second. And then the investment style, active ETF. Now, one question we had when looking at the name, what is US 100Q?
In the US, there is an index called the NASDAQ 100. And it's all affectionately known as the Qs because there's an ETF in the US that's the triple Q, QQQ. So oftentimes the letter Q can allude to the fact that it's going to use as its reference benchmark the NASDAQ 100. And the NASDAQ 100 tends to be a growthier group of stocks, a little more tech focused, maybe a little more state-of-the-art, cool AI type of stocks. But it's definitely a little growthier and a little techier than just the traditional US benchmarks.
Oh, nice. So, Hamilton, we'll start with the purpose of the ETF. So what is the purpose of JPEQ?
Income. Income is the purpose that we look to give to our clients around a actively managed, as Ren said, group of stocks that are going to be a little growthier and a little bit more tech focused. And given that income is the outcome, we often like to say that the income is epic, just like JPEQ.
Nice. Now, the NASDAQ 100 group of stocks aren't known for as income payers traditionally. So how do you achieve that purpose of income with this group of NASDAQ 100 stocks?
Sure. So it's a great question because that is one of the elegant aspects of this strategy, because when you're thinking about growth stocks and tech stocks, you don't tend to think of income in the same sentence ever. So what we look to do is we look to sell options on the NASDAQ 100 to generate some income. And by doing that, we can actually offer investors some growth stocks, some tech stocks, and well above average levels of income because we're selling calls. Those calls plus modest, and I mean very modest dividends that equate to less than 1%, usually enable us through a cycle to give our investors 9 to 11% distributable income paid out monthly.
That's music to a lot of people's ears there.
That is solid. Now, Hamilton, when looking at the benchmark, you guys benchmark against the NASDAQ 100 total return. Why would I not just take that as my underlying ETF? And what advantages are there in having an active ETF?
When you're thinking about the index is a wonderful index, has lots of great companies. But some of those companies aren't as great as other ones. So our goal being active is to own a little bit more of the names that we like and own a little bit less or none of the names that we're not as enamored with when it comes to that index. So active does not mean just buying a few names or buying fewer names. It's really just fundamentally buying the stocks that you think can perform above average and actually owning a little bit less than the ones that you expect to perform below average. And so our strategies, the NASDAQ 100, and interestingly enough, the reason it's called the NASDAQ 100 is because it's the 100 largest non-financial names in the NASDAQ index. And so we're going to own probably between 70 and 90 names. Today we own about 80.
Okay. And I guess when you think about this fund and the purpose of it, how's it designed to fit into an investor's portfolio?
Sure. So number one, when we think about where it fits into investors' portfolio, it is a more conservative way of getting exposure to growthier and techier stocks. We expect this strategy to have about 25% less risk, if you will, than the NASDAQ 100. And that's accomplished by two things. One, because we're selling options, and two, based upon that active stock selection. So fitting into a portfolio, there's many people that are a little bit nervous about tech and growth. So this can fit as a more conservative way of getting tech and growth exposure. But probably the main primary way we see people using this is income. I mean, to get 9 to 11% income paid monthly and to be able to own these tech and growth names with less risk tend to be a really nice way of fitting into a portfolio.
Well, we'll get to the distributions and the performance in a second. But before then, we always have to look at fees. And if we go to the JPMorgan Asset Management website, we can see the fees for this fund, 0.4%. Or 40 basis points, which is the equivalent of 40 cents per $100 invested.
Love that.
Yeah, I think we said this in the last episode. It feels like that's on the lower end of active managed ETFs, so we love to see that.
Me too.
Yeah. But let's turn to performance. Now, this fund has only been listed in Australia since May 2023. So the longest comparison we have is a year. The benchmark, NASDAQ 100 total return, delivered just over 30%, and this ETF has delivered just shy of 24%. And so, as you were saying, you give away some of the upside for that income stream. And then let's turn to that income stream, because in the 12-month rolling distribution yield, 8.15%, paid out monthly.
Pretty healthy.
Pretty healthy. Yeah. The fund has been listed in the US for longer. How's the performance and the distributions looked over a longer time period in the US?
So in the US, it's the same exact strategy that is here in Australia. The ticker in the US is JEPEQ, but it's the same exact strategy. And the performance has been quite healthy. In 2023, the NASDAQ 100 ripped. It was up 55%.
Yeah.
And this strategy, including the income, was up over 36%. And our clients were pretty happy with us because coming out of 2022, if you recall, no one really liked growth stocks. No one really liked tech stocks. And to be able to get exposure with income and do it with less risk relative to the index was quite a nice way for people to get that exposure. So it's done what we expected to do. And then Star Wars. I am a Star Wars geek. And we did launch the strategy in the U.S. on May 4th of 2022. So may the 4th be with you guys.
Nice.
Okay.
Now, Hamilton, I think Ren alluded to it earlier. The NASDAQ's not known for its dividend-paying companies, and I think the index has a distribution yield just shy of 2%. So how are you actually getting or achieving over 8%?
Actually, our long portfolio is going to have about 80 to 100 basis points of dividends. And then the rest we would anticipate and is from selling options. And options are one of those things, in the case of here, they have utility value. And that utility value is taking the bird in the hand of income today in return for potentially giving up some of the upside in the future. Now, in many cases, it's a good trade-off because the idea of saying, I know what I'm going to get from an income perspective, and in return, maybe giving some of the upside, is something that in many cases fits a lot of people's portfolios because you take the bird in the hand, you kind of have a good idea as to how it's going to fit into your portfolio. And some people actually like the income and they take the income. And then there's other people that say, I just like the return of the income and I reinvest it back into the ETF.
Now, Hamilton, we always like to look at the top holdings, and looking at this list of top holdings, it looks very similar to the NASDAQ 100. It's big tech, it's Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta topping the list. But one thing that did pique our interest and would be interested for you to explain it is the 9th and 10th top holdings don't look like stocks. It's NDX 10 and NDX 14. Now, for people who are doing their research and they come across codes like this, what are they?
So first of all, don't you like the top 8 names? Isn't that a good group of 8 names to want to own an ETF and get income?
Yeah.
The last 2 securities are actually bonds, and they are bonds that hold the short options that we sell. And the reason we do that, because in the US, there is a rule that says that options don't count as income. And we really, given that this is an income-oriented strategy, we want to make sure that our options are truly traded as income in the US. And by doing this, which also translates to the Australian ETF, because the Australian ETF holds the US ETF, it ensures that that income that we distribute is bona fide income. And so think about those two securities as just a holding vessel, holding our short options such that it converts our options premium to being a coupon, real income.
Yeah.
Nice.
Makes sense.
Straightforward. So Hamilton, before we wrap up, in our previous episode, we did JPEQ, which was the JPMorgan Equity Premium Income Active ETF, which tried to emulate or track the S&P 500. And today we're looking at the NASDAQ. Got to ask you, when putting one next to the other, which one is your favorite?
They're both my children. And I love all of my children. And the way we think about these strategies is, what type of stocks do you want to own? If you want to own a more conservative, higher quality group of stocks like Train and Progressive and Amazon and Meta and Google and Visa and MasterCard, then buy JPEQ. It's going to have very good income, and you're going to like the type of stocks you own. If you want to own something a little growthier and techier, something that has NVIDIA and Apple and Microsoft and names like that, then buy JPEQ. Because then you'll be pretty happy with not just the income, but the type of stocks you own. Because when it comes down to it, all of these type of strategies are equity investments. Just happen to throw off a fair amount of income. So what type of equities do you want to own? But let's just say you want something that looks not overly conservative and not something that's overly growth and tech. If you actually pair these strategies together, about 40% in JPEQ and 60% in JPEQ, you end up with an overall portfolio that's going to look a lot like the S&P 500. And so we see people buying one, buying the other one, or actually putting them together as a pair. So it always starts with, what type of stocks do you want to own? Do you want to own something that looks like the S&P 500? Pair them together. Growthy and techier, JPEQ. Or just that more conservative, higher quality portfolio than JPEQ.
Nice. That's an answer a good parent would say.
Yeah. Well, if you have listened to the last two episodes and you feel like we're too US centric, don't worry, because in the next episode we're going to be introducing the third child, and that is JEGA, JEGA, which takes this strategy but applies it with a global focus.
Yep.
So Hamilton, we appreciate you joining us for that episode, but that does it for this one. So we appreciate your time and thanks for joining us.
Thanks for having me, guys.
Thank you.